Welcome to the Tech Index AI podcast, June 17th, 2026, where we blend tech IP data, reports, and charts with the latest news in all things logistics with a focus on air cargo. And imagine turning on the news, seeing global tensions cool and oil prices plummet, only to open your latest freight bill and, well, realize your shipping costs just defied economic gravity and surged another 48%.
Yeah, it is a completely wild scenario for anyone managing a supply chain right now.
Exactly. So today, the mission of this deep dive is to explore exactly why the macro market is behaving so irrationally and how the entire concept of supply chain agility is, being rewritten right under your feet.
Right. So to grasp why these freight bills are defying gravity, we really have to look at the macroeconomic shockwave from this past week. I mean, we just saw a 60-day U.S.-Iran ceasefire announced.
Right, along with the anticipated reopening of the Strait of Hormuz.
Exactly, and markets reacted instantly. Brent crude oil took a sudden dive, dropping below $80 a barrel to its lowest level since early March.
But, and here's where the data reveals a massive geographic mismatch. Instead of rates dropping, the latest TAC index data shows the global Baltic air freight index actually gained 1.3% last week.
Yeah, it's sitting 34.6% higher year over year, which is just staggering.
It really is, and it's wildly uneven, too. Like, Frankfurt outbound rates jumped 6.6%, while Shanghai dropped slightly by 1.6%.
So it shows the capacity isn't just tight, right? It's in the completely wrong places at the wrong times.
So, okay, the logistics market is usually like a giant shock absorber. If global tensions are cooling and crude oil is dropping, why on earth are air freight rates still hovering above these peak season highs?
Well, that geographic mismatch is a critical piece of the puzzle. The equities markets are aggressively pricing in the normalization of the Strait of Hormuz. But the physical air cargo market is operating in a completely different reality.
Okay, but let me challenge that slightly. I mean, everyone in logistics knows there is a lag between crude oil dropping on the exchange and jet fuel dropping at the pump.
Right, the standard fuel lag.
Yeah. But even with that lag, shouldn't market sentiment and, the drop in futures contracts alone start driving those spot rates down immediately?
You would think so, yeah. But the basic fuel lag is really only half the story here. Think of airline fuel hedging like buying a house at the peak of the market.
Oh, like getting locked into a fixed mortgage at 7% interest?
Precisely. It doesn't matter to the airlines. If the central bank drops rates to 2% today, they still have to pay the premium they locked in yesterday.
Yeah.
So air cargo hasn't felt the relief yet because capacity remains highly constrained.
Ah, got it. So airlines are intentionally maintaining tight physical capacity despite the ceasefire to recoup those prior premiums.
Exactly. And because shippers are choking on these intentionally extended air cargo rates, they are naturally flooding the alternative, right? The ocean market.
Right. But the ocean market they are running to isn't the one they remember from last year. It's a fundamentally, permanently altered market now.
Far from it. I mean, last year, ocean shipping costs dropped 36%. That was largely because the massive new vessels ordered during the pandemic finally hit the water.
Bringing a huge surge of new capacity, right?
Yeah, and shippers got comfortable. But look at the recent data. Short-term contract rates to ship an ocean container from Asia to the U.S. West Coast just surged nearly 48% in a single month.
Wow. Nearly 50% in 1 month. Logistics costs are just rising across the board.
Yeah, that cheap, abundant capacity vanished the absolute moment demand spiked.
So if you are managing goods in transit right now, you really can't go back to the pre-pandemic normal. I mean, those old supply chains were like massive, slow-moving cargo ships that relied purely on scale.
Right, waiting for calm waters. But U.S. companies are abandoning the wait for normalcy. The reports show a mechanical shift toward agility.
So how are they executing this agility? Because it's fascinating to see in the data.
Well, they are actively blending spot and annual ocean contracts. By keeping a portion of their volume on the spot market, they can capitalize on sudden dips.
Oh, and the annual contracts protect their baseline during the surges.
Exactly. Furthermore, they're deliberately diversifying their cargo allocations across multiple ports, east, west, and Gulf coasts simultaneously.
So they are prioritizing decision-making speed over sheer buying power. If a disruption hits the West Coast, they don't negotiate a brand new route. They just instantly shift their volume to their Gulf Coast allocations.
Precisely. They have moved from relying on size to relying on reflexes.
Which leaves us with a pretty intense thought to mull over. As global supply chains pivot entirely toward agility and rapid reactions, what happens to market stability?
It's a huge unknown.
Right, like does the simultaneous scramble to reroute cargo at the first sign of the next global disruption actually create the next massive bottleneck?
That is the multi-trillion-dollar question for the road ahead.
Until next time.